Hello and welcome. You're watching the collab show between Business Today and India Today Television. This is the market closing show. Last 10 minutes to go before the market shuts shop. It's presented by NSC. Let me quickly welcome all our guests joining in. Saurabh Mukherjea, founder and CIO, Marcellus Investment Manager. Swarup Mohanty, CEO, Mirae Asset Mutual Fund. And we also have with us Dheeraj, Reli, MD and CEO of HDFC Securities. Welcome to all of you. Thank you for standing by. The Finance Minister just took some of the questions from media on the budget that she is presenting. Sort of coming to you first, what do you think is the key reason why the markets are disappointed so much? 2% down for the Nifty, 24,800 has been given up. Is it the disappointment on STT or is it the disappointment of some more announcements that have gone missed?
I think the market had unrealistic expectations going into the budget. We're living in a country where dollar EPS growth, right, is close to zero now for 2 years. And the market trades at 20 times forward, right? So you can just just to give you a sort of headline view of how unrealistic views are. Earnings growth in rupees is 5%, in dollars is barely anything. The market trades at rich multiples compared to any other country. And therefore, the unrealistic nature of expectations meant that they were more likely than not to be disappointed. I think the FM hasn't done anything wrong. It's a good budget. It was a high time that F&O taxes were increased. I've been shouting myself hoarse for the last couple of years that this doesn't make any sense. We have 1 trillion rupees of speculative activity in F&O markets. Much of that money is ending outside India as smart algo traders on Wall Street take retail investors in India to the cleaners. I'm glad that the FM has decided to tax that activity at higher rate. It's basically a sin tax. It's a good idea. And the second, I think, positive thing she's announced is a big review of the banking sector. I don't know exactly how the review will play out, but unless the FM wants the repetition of the status quo, there is possibility that the review of the banking sector leads to more foreign capital, perhaps more foreign corporate capital also entering the banking system. More capital in the banking system is much needed given where we are with many of our smaller banks struggling with profitability. The only negative I could spot was this obsession about jacking up Capex, which obviously results in more borrowing in the bond market. I think tomorrow morning when the bond markets open in India, we'll see bond yields going up. And that's unwelcome, especially since the CE has said, the chief economic advisor has said India needs cheaper capital. I'm not quite sure how the government borrowing more money in the bond market is going to reduce the cost of capital for the country. But in difficult circumstances, a decent budget. I think the market being disappointed is more the market's own unrealistic expectations than anything that the FM has done.
Right. Let me come to you, Dheeraj, and quickly ask you as well, what stood out for you in this budget and where do you think the finance minister could have done more?
I think this budget is a more nuanced and fine print oriented budget rather than, a big bang reforms. We've seen government continuing to focus on the Capex side. I think that is good because India is a infrastructure deficit country and Capex has its own repercussions on the employment and growth also. So to that extent, I think more or less FM has ticked all check boxes, no big bang reforms. Yes, STT increase in F&O have been a dampener, and I think this is a knee-jerk reaction in the market. Maybe there for a couple of days, and then markets will move on from here. What I think FM could have done better. My take is that we have good enough of assets available with the government to monetize. I don't know why they are reluctant to monetize the assets, because with that monetization of assets, they can get funds and they need not to borrow more from the markets. So that would assuage the concerns Saurabh was pointing out. Government is sitting with a lot of assets and they must look at monetizing the same. They can also reduce their stakes in some of the PSU banks also. Hopefully the high-powered committee, sustained committee could work in these directions.
Okay. Swarup, to you as well. On a scale of 1 to 10, how would you rate this budget and what adjective would you use to describe this one?
If you just take out the stock market perspective and look at it from a broad India, what can I say, destination or path story, I would rate it 8 to 9. But at this moment, it's completely wrong to discount the stock market at a time when people are abandoning India with the quantum of money that's going out. That was a message being given to the country, and I'm not against the implementation of STT, but I think it could have been avoided. provided at this moment. Please understand today the FIs are not at play in the market. We'll come to see the full impact tomorrow. And see, there is a lot of noise on the world. We can ignore that noise and continue our path of fiscal prudence, which the budget has continued, which is, I think, controlling the controllables. I think when you look at the broad budget, I think the focus on that has been a standout. A lot of factors which the world was screaming out, because the world's divided into two parts. Again, speaking from a stock market perspective, of there's an AI world and a non-AI world. Yes, we've addressed our intent to be there through data centers and semiconductors. That's an intent. Time will tell whether people will take that bait. Now, the concern for the country has been private capex. The government cannot be, ticked anywhere out of 10 on its intent on public capex, which it continues. This is a phenomenal budget, but time will tell whether people will take the bait on private capex. The other part, which is very significant for me, is at 9% unemployment, this budget also lays down the ground for the beginning of employment across sectors. Which these were three things which stood out for me. But ignoring the stock market, we'll come to see the full impact tomorrow.
That's where the impact is. Okay, Saurabh, to you as well. Do you think this budget has done enough on two accounts? Taking a leaf out of what Saurabh also mentioned, Swarup also mentioned, and that's as far as the private capex is concerned. That's been subdued. We've seen only the government doing all the heavy lifting. Will it finally pick up? And second of all, will FIIs come back that have been awaiting us?
So, two aspects to understand on private capex, right? A promoter of a private sector company looks at demand. If you have tax revenues growing at 3 to 4% in a country, if you have capacity utilization at 70-75%, right, but demand has been weak for a couple of years now, job creation in the private sector is anemic, real wage growth in the private sector is negative. Difficult to see why a promoter should press the back button on capex. After all, he or she, the promoter, is a profit-oriented creature. And if he does not see the ground level economic activity to justify private capex, I'm not so sure what the FM can suddenly do to trigger private capex. So I think that's the first piece. It will be a while before we can see private capex, because job creation, private sector job creation, especially white collar job creation, does not seem to be happening at this juncture. Coming to FPIs, or let's focus on FPI money, the point that Swarup was saying, where FPIs are heading for the door. The FPI's bone of contention is very simple. Their point is, look, you're one of the few countries in the world which taxes us at destination. Most countries have residence-based taxation. Most countries do not tax FPIs. We are one of the rare countries which taxes FPIs. When we were a country where earnings growth was in 15% or high teens, right, FPIs were happy to pay that tax. Now they're saying that there is no earnings growth in dollar terms. Valuations are rich, and yet you guys continue taxing us. And their point is, why should we therefore invest in your country? Now, I'm not the person to address that issue. I think it's high time that between now and the next budget, the government and the FPIs have a chat with each other and figure out a middle ground which suits both sides, because I don't see FPIs returning to India with the GT regime that currently prevails for foreign investors.
Okay. Dheeraj, coming to you. We just are a few seconds away from the market shut sharp, maybe 1 minute to go, and we're already down sharply across the board. There's a broad-based sell-off. So the markets are clearly unhappy with what the budget has done. But for an average retail investor, from tomorrow, what is the strategy you're advising them? Is it back to earnings, back to tracking those companies which are, tracking with profitability? How should one be really understanding what their strategy should be post this budget?
One thing they can do is to relook at their portfolios and try and optimize their portfolios in the sectors where we see better earning growth. Because ultimately, budget or geopolitical issues, these are more bigger noises only, and they'll have to focus on the earnings. And we can safely assume that FY27 will be a better year for earning in terms of quality of the earning, and overall earning should be better. That's what our estimates are. And that's where we believe that they can look at the sectors which are where we have better potential for earning. BFSI is one space they can look at. I know PSU banks and some of the banks got hammered today, and capital market stocks are also hammered. But my take is that BFSI is one strong sector. And with the impetus given in the GST 2.0 and last year relief in the taxation and no tweaking this year, I think the benefit will continue, and that continuity should provide more money in the hands of Indians, and that should pay well for the consumption related stocks. And now that they haven't seen the volume growth, they have been riding on only on premiumization in last few years. We are hoping that the demand will pick up in the next fiscal, and that's where consumption oriented stocks and low cost discretionary stocks should do well.
Okay, let me quickly just wrap up the markets and come back to all of you. 24,825 barely moved up above that 24,800 mark, but ending 495 points lower on the Nifty today. The Nifty Bank also has seen a sharp fall in today's trading session, viewers, especially led by the fall in the PSU banking story, 2% down, 1,193 point of a cut on the Nifty Bank. All the sectors have slipped into the red, barring just minute gains on the IT sector today. It's the India VIX that shot up almost 11%, indicating heightened volatility in trade today. Look at what the metals are doing. Last couple of sessions, we've seen heavy sell-off, and it again ends with about 4% losses in today's trading session as well. PSU banks are coming under heavy pressure, something that Dheeraj was also marking out, that it's the borrowing that the government has indicated in the budget, a record borrowing of over 17 lakh crore rupees, and that's creating some pressure there. Look at the defense stocks. There has been an increase in the outlay, but you still see the index down by 5% in trade. So it's an all across the board sharp sell-off that you've seen in the markets today. A lot of those stocks also getting under pressure. Let me come to you, Swarup, and try and understand, what should be an investor's understanding of asset allocation from here. Up until thus far, people were riding on this entire FOMO of gold and silver, jumping onto every opportunity, riding it high. But bang comes the sharp correction, which anybody of us would have anticipated, but not so sharply in just the last 2-3 sessions as to what has happened. For those investors who were heavy on gold and silver, what would you advise? For those under equities, what would you advise?
See, my smile was whenever I hear the term asset allocation, a smile comes to my face because asset allocation only happens on Twitter. In real terms, people buy last 1 year returns. If you're talking about the frenzy of gold and silver in the last 6-8 months, there was a frenzy of small caps prior to that, right? Till that is not corrected and investor behavior does not get into future thinking, asset allocation will not happen. That's the truth, right? And so there are two types of people in the market. One is a buyer, one is a seller. Buyer wants the market to go up. The buyer wants the market to go down. The seller wants the market to go up. Now, anybody who looks at the macro of India, it's probably the strongest macro globally. As a decadal growth, if you see 6.5-7% growth consistently, is probably the most consistent growing country in the world. That's where you sit. I mean, as a buyer, I'm very happy that the market's where it is. I would probably top up my SIPs a bit and leave the worrying of which stock to buy to the fund manager. Once I give it to the fund manager, I would refrain from being a fund manager over the fund manager and keep it simple. Some of the valuations and what Saurabh actually referred to at the beginning is something which people should know. Whenever the market is in an overbought situation or overvalued situation, such triggers lead to a sell-off, and it will get into a far more realistic space and a good space for investors to be.